The Fed has two objectives. One is to keep employment high, and we've got full employment right now. And the second objective is to stop inflation. We really don't have any inflation. So I think this is a perfectly good move.
You know, Dan, maybe a needless worry ward, but normally when I see the Fed even talking about this sort of thing, it provides enough caution that we don't get what we're getting now. Now, maybe it's different now. I've heard that again and again. What do you make of all this?
Put me in the worry wart column as well. I don't think that you solve underlying structural problems in the economy with artificially low interest rates. I worry that there might be a bit of a bubble already in the economy, and I think simply pumping more money in the system is not the right solution.
Well, you know, the contrary argument to that, I'm sorry to jump on you there, my friend, but they wouldn't be artificially low. They'd be justified. You don't buy that, right?
I don't buy that, or at least let me put it this way. I'd much rather deal with the underlying issues that structurally threaten the economy, such as the fact that we have too much regulation, the fact that Trump is threatening all sorts of tax increases on trade. Those are the things that I think we should deal with, not simply just hope and pray that the Fed bails us out with the morphine of easy money.
Well, what do you think, Paul, about for those trying to play this market now? It's sort of like a schizophrenic read. I know this week is one thing, last week quite another thing. Which is real?
Well, I think we got to watch this play out. I mean, if we see a trade deal with Mexico and the United States in the next month or so, we're going to be just fine. And I think the Fed, if it cuts rates, will only cut rates once this year if we get a trade deal. If we don't and it goes on, then I think we could see 2 rate cuts in 2019. I think the stock market will boom because I think all of the concern over the cost to the consumer of these tariffs is overblown. I mean, we just watched Mexico's peso drop significantly against the U.S. dollar because of their bond rating has gone down and because of this trade deal. That's going to offset at least the next 2 months of 5% tariff increases, and I think it will be settled before that point. We haven't seen any real raises in prices because of the 10% tariffs on China, because China manipulated its currency and dropped it by about 10%. So
well, you would see it
really
real
haven't
quickly,
seen
Dan,
anything.
you would see it at 25%. You can only absorb so much, right?
That's correct.
Dan, what do you think of that?
I think we need to keep in mind that easy money doesn't just show up in higher consumer prices like we saw in the 1970s. Sometimes easy money policies show up in asset bubbles, like we had with the dot-com bubble in the late 1990s and like we had leading up to the housing bubble in 2008. So we need to be careful about relying on the Fed to somehow bail us out of bad policies because that creates its own set of problems.
Well,
but I don't see any asset bubbles. Where are the asset bubbles?
Well, nobody saw them in 2007 either. I hope I'm wrong. I'm simply pointing out that easy money is not the route to prosperity. Sound, structural, good policies, low taxes, small government, deregulation, and open trade.
Well, the asset
that's
bubble
what we
that you
should be
hear
doing.
is at the bond market. That's showing you there's a bubble there. You don't buy that, right, Paul?
No.
Okay. There you go.
And I mean, I don't know anyone who didn't see the mortgage crisis in the last one or the dot-com bubbles. We were talking about it. Go back to the Wall Street Journal. They were talking about it every day. It's
Everyone
just nobody
has great
paid any
hindsight,
attention to it.
We'd all be billionaires if we knew when these things would happen.
Gentlemen, I want to thank you both very, very much.